18 months. That's how long you have to reposition your portfolio before the next massive transfer of wealth from the unprepared to the prepared. Not 2 years, not 5 years. 18 months. I've studied debt cycles for 50 years. I predicted 2008. I called the dot-com crash. And right now, every signal I track is flashing red. We're in stage 7 of an 8-stage debt cycle. The final stage destroys 50 to 60% of conventional portfolios, but it doesn't have to destroy yours. There are 4 investments that survive what's coming, only 4. And in the next 20 minutes, I'm going to show you exactly what they are, why they work, and how to own them before that window closes, quietly and permanently. Here's what nobody's telling you. These cycles happen every 75 to 100 years. The last one was the 1930s and 40s. And when they end, they don't end quietly. They end with massive wealth transfers from people who own the wrong assets to people who own the right ones. I'm going to show you exactly what those 4 assets are, why they're the only ones that preserve wealth when everything else collapses, and how to reposition your portfolio before it's too late. But first, let me start with a story that will explain why this matters more than anything else you'll hear this year. In 2006, I met a man named Richard. He was 54 years old, a successful engineer. He had accumulated $1.8 million over 30 years of disciplined saving. He was following all the conventional advice: 60% stocks, 40% bonds, working with a major wealth management firm, paying him nearly $20,000 a year in fees to tell him to stay the course. I sat down with Richard in my office. I told him what I'm telling you now. We're late in a debt cycle. Housing is over-leveraged. Banks are holding toxic assets that nobody understands. A crisis is coming. You need to reposition into the 4 assets that actually survive these events. Richard didn't listen. His advisor told him I was being alarmist. They showed him charts going back 40 years, proving that stocks always recover. They said the fundamentals were strong. They said diversification would protect him. They said my concerns were overblown. So Richard stayed the course. 2007 came. The market kept going up. Richard felt vindicated. His portfolio hit 2.1 million. He started planning an early retirement. His wife picked out a vacation home in Florida. They booked a Mediterranean cruise for the following year. Then 2008 hit. Richard's portfolio dropped 54% in 18 months. That 2.1 million became 970,000. Everything he'd built over 3 decades cut in half. He was 56 years old. His advisor told him, don't panic, don't sell, it'll come back. But Richard didn't have time. He needed that money to compound for retirement. The market didn't fully recover until 2013. He was 61 by then. His retirement calculator showed he was over $800,000 short of his goal. He pushed retirement to 65, then to 67, then to 70. I saw Richard last year. He's 72 years old now, still working, not because he loves his job, because he has to. The Florida home never happened. The Mediterranean cruise never happened. His golden years became his working years. And here's what kills me. Richard wasn't stupid. He wasn't reckless. He followed the rules. He trusted the experts. He did everything conventional wisdom told him to do, and it destroyed him. The advisor who told him to stay the course, retired at 58, lives in Palm Beach now, plays golf 5 days a week. Don't be Richard. Let me explain exactly what's happening right now and why you have maybe 18 months to reposition your retirement portfolio. The economy is not random. It's a machine. And that machine runs on 3 forces: productivity growth, short-term debt cycles, and long-term debt cycles. Productivity growth is simple. Are we producing more value per person this year than last year? If yes, the economy grows. If no, it stagnates. Short-term debt cycles last 5 to 8 years. The economy expands. People borrow money, they spend it. The economy heats up. Central banks raise interest rates. Borrowing becomes expensive. Spending slows, the economy contracts. Central banks lower rates, the cycle repeats. This is why you see recessions every 7 to 10 years. It's not random, it's the machine cycling. There's a third cycle operating underneath that most people never see. The long-term debt cycle. Over decades, debt accumulates. Government debt, corporate debt, consumer debt, all that building up year after year. And eventually you reach a point where the debt becomes unsustainable. You can't service it anymore. You can't grow your way out of it. You can't refinance it at lower rates because rates are already at historic lows. That's where we are right now in 2026. Total United States debt, government plus corporate plus consumer, is over $90 trillion. Government debt alone is $38 trillion. That's 125% of GDP. The federal government now spends over $1 trillion per year just paying interest on existing debt, more than it spends on defense, more than it spends on education, more than it spends on infrastructure, just interest payments. When interest costs exceed defense spending for the first time in modern history, that tells you something critical. The debt load is unsustainable, and here's the problem. When you're at the end of the long-term debt cycle, you only have three options. Option one is defaults. Governments, corporations, individuals stop paying their debts, bankruptcy, massive wealth destruction. Option two is restructuring. Debts get renegotiated. You owed $100, now you owe $50 paid out over 20 years. Sounds nice until you realize if you're the lender, you just lost half your money. Option three is inflation. Print enough money and the debt becomes worthless in real terms. You owed $100,000 in 2020. By 2030, that same $100,000 is pocket change because the currency collapsed. Great if you're a debtor, catastrophic if you're a saver. And guess which option central banks always choose? Inflation. Every single time. They'll never admit it openly. They'll call it quantitative easing or stimulus or monetary accommodation or whatever. Sounds less terrifying, but it's money printing, creating currency out of thin air to devalue the debt. And when they do that, the dollars in your bank account, the dollars in your retirement accounts, the dollars you've been saving for 30 years, they buy less, a lot less. I've studied 500 years of economic history. I've mapped every major debt cycle since the Dutch Empire. The pattern is always the same. In the 1930s, it wasn't just stocks that got destroyed. Government bonds defaulted, corporate bonds defaulted massively. Stocks dropped 89% peak to trough. The only people who preserved wealth were the ones who owned four specific types of assets. Physical gold, businesses with pricing power, short-term government securities, and productive farmland. In the 1970s, the same pattern repeated. Bonds got destroyed by inflation. The 10-year Treasury lost over 60% of its real value from 1970 to 1980. Stocks went essentially nowhere for a decade, but when you adjust for inflation, which ran at 7 to 9% annually, real purchasing power for stock investors declined by over 50%. Someone who bought stocks in 1968 didn't break even in real terms until the early 1980s. 13 years of zero returns. 13 years watching purchasing power evaporate while advisors said stay the course. But four types of assets exploded. Gold went from $35 per ounce to $850, a 24 times return. Businesses with pricing power like energy companies saw revenues go up 700%. Short-term treasuries protected capital and provided optionality. And agricultural land doubled and tripled in value. The pattern repeats every 75 to 100 years. When debt cycles end, paper assets collapse. Only four types of assets hold value. Now let me tell you about someone else. A woman named Margaret. She reached out to me in 2011, 3 years after the financial crisis. She was 68 years old. Her husband had passed away 2 years earlier from a heart attack. She believed the stress of watching their savings collapse contributed to his death. They had saved $1.4 million by the time he retired at 65. Their advisor put them in a typical balanced portfolio. 70% stocks for growth. When 2008 hit, they lost over $600,000. Her husband couldn't handle it. He would wake up at 3 a.m. checking their account balance. He stopped eating properly. His health deteriorated rapidly. Margaret wrote to me because she wanted other people to understand something. The real cost of following conventional advice isn't just money. It's years of your life. It's your health. It's watching someone you love suffer because they trusted the wrong people. She said if she could go back, she would trade every dollar of potential upside for the peace of mind that comes from owning truly safe assets. Don't let this be you or someone you love. Let me show you the 4 investments that actually survive when the machine breaks. The first truly safe investment is physical precious metals, gold and silver that you own and control, not gold ETFs, not mining stocks, not paper gold. Physical metal you can hold. Here's why this matters for your retirement portfolio. Throughout history, every time a currency collapses, gold survives. It's the ultimate insurance policy against monetary stupidity. In the 1970s, when inflation destroyed everything else, gold went from $35 to $850. Someone who put $10,000 into gold in 1970 had $240,000 by 1980. Someone who put that same $10,000 into the S&P 500 had maybe $12,000 after inflation. In the 2000s, when the housing bubble burst and central banks printed trillions, gold went from $250 to $1,900, a 7 times return. In 2025, gold went up over 70%. Silver went up over 140%. The market is already pricing in monetary stress. Physical gold and silver should represent 10 to 15% of your liquid net worth, stored in secure vaults across multiple jurisdictions. You hope you never have to use it. But if the dollar loses 50% of its value over the next 10 years, that gold doubles in dollar terms while everything else collapses. It's not an investment, it's insurance. Insurance always has a cost. In good times, gold underperforms stocks. That's fine. That's what insurance does. It sits there doing nothing most of the time. But in bad times, when your stocks and bonds are getting crushed, gold holds steady or goes up. That 10 to 15% allocation could be the difference between retiring comfortably and working until you're 75. How do you actually buy physical gold and silver? You have 3 options. 1, buy directly from reputable dealers like APMEX or JM Bullion. They ship to your home, or you can arrange vault storage. 2, use allocated storage services like Bullion Vault, where you own specific bars stored in secure facilities. 3, visit local coin shops for smaller purchases, but verify their reputation first. Start with 1-ounce gold coins like American Eagles or Canadian Maple Leafs. For silver, consider 10-ounce bars or 1-ounce rounds. Expect to pay a premium above spot price, typically 3 to 5% for gold and slightly more for silver. Never buy numismatic coins marketed as collectibles. You want bullion, pure metal, nothing fancy. The second truly safe investment for preserving wealth is businesses with pricing power. Not stocks, not index funds, individual businesses that have 3 specific characteristics. 1, they can raise prices faster than inflation. 2, they generate cash flow you can live on. 3, they own hard assets or intellectual property that holds value when currency is being debased. In the 1970s, when inflation ran at 10 to 15%, most stocks got destroyed. The S&P 500 went essentially nowhere, but certain companies exploded. Energy companies that owned oil and gas reserves. When oil went from $10 a barrel to $80, their revenues went up 700%. Their costs went up maybe 50%. Massive profit expansion, utilities with regulated returns. When their costs went up, regulatory frameworks let them pass those costs through to consumers with a guaranteed margin. Consumer staples with monopolistic positions, Procter & Gamble, Johnson & Johnson, Coca-Cola. These companies raise prices when their costs go up. Consumers complain but keep buying because brand loyalty is strong and the products are essential. Think about Procter & Gamble. They own Tide, Pampers, Gillette. When their manufacturing costs go up 20%, they raise prices 25%. Consumers might switch from premium Tide to regular Tide, but they don't stop buying detergent. That's pricing power. Johnson & Johnson owns Band-Aids, Tylenol, medical devices. When inflation hits, hospitals don't stop buying medical equipment. They pay the higher price. Now, these aren't get-rich-quick plays. These are wealth preservation plays. When inflation hits, these companies don't just survive, they thrive. You should allocate 30 to 35% to businesses with these characteristics. Companies that own hard assets, have pricing power, and generate reliable cash flow. How do you find these businesses? Look for dividend aristocrats, companies that have increased dividends for 25 consecutive years or more. This list includes about 65 companies. They've survived multiple recessions and maintained pricing power through every economic cycle. Focus on 3 sectors. Consumer staples like Procter & Gamble, Coca-Cola, and Colgate-Palmolive. Utilities like NextEra Energy and Duke Energy. Healthcare like Johnson & Johnson and Abbott Laboratories. Check their dividend history. A company that raised dividends every year for 30 years has proven pricing power. Check their payout ratio. You want it below 60%, which means they're not stretching to pay dividends. Buy equal positions in 6 to 8 companies across these sectors. This gives you diversification within the pricing power bucket without overdoing it. The third truly safe investment is short-term United States Treasury securities. This sounds boring, but it's actually the most important position in your portfolio right now. 90-day to 2-year Treasury bills earning 4 to 5%. And cash equivalents and money market funds backed by treasuries. This is your dry powder, your optionality, your crisis ammunition. When the crisis hits, and it will hit, you want cash, because that's when the best opportunities appear. In March 2008, high-quality corporate bonds were trading at 60 cents on the dollar. If you had cash, you could buy them. 12 months later, they were back at par. 60% returns with minimal risk. In March 2020, when COVID panic drove stocks down 35% in 3 weeks, cash was king. If you could deploy at the bottom, you doubled your money in 6 months. The people who made fortunes in those crises weren't the smartest. They were the most liquid. Keep 20 to 25% in short-term treasuries and cash. It earns 4 to 5%, barely keeps up with inflation, but it gives you optionality. When everyone else is panicking and selling, you're buying. Right now, short-term treasury yields are the highest they've been in over 15 years. You can earn 4 to 5% with complete safety of principal and full liquidity. This won't last forever. When the crisis accelerates, the Federal Reserve will cut rates to 0 again. That 5% becomes 1% or less. Lock in these rates now while you still can. How do you buy Treasury securities? The simplest way is through Treasury Direct, the government website. Open an account for free. Buy Treasury bills directly with no fees or commissions. You can set up a ladder where bills mature every month, giving you regular access to cash. Alternatively, use a brokerage account and buy Treasury ETFs. Ticker symbol SGOV holds short-term Treasury bills. Ticker symbol SGOV holds 1 to 3 month bills. These trade like stocks but hold only government securities. For cash equivalents, open a money market account at Vanguard or Fidelity. Their Treasury money market funds currently yield around 4.5%. Your money is liquid, you can withdraw anytime, and it's backed entirely by Treasury securities. The fourth truly safe investment is productive real assets that generate income. Agricultural land, rental properties, infrastructure assets, farmland REITs, things that produce food, shelter, energy, things people need regardless of what happens to paper currency. In every debt cycle crisis, real assets hold value because they produce something tangible. During the 1930s depression, farmland values held relatively stable in real terms while stocks and bonds collapsed. Why? Because farmland produces food, and people need to eat regardless of what's happening in financial markets. In the 1970s, agricultural land doubled and tripled in value as food prices soared. Rental properties performed well because rents increased with inflation. Real assets have two characteristics that make them safe. First, they produce income. A farm produces crops, a rental property produces rent. That income stream continues regardless of what the asset is worth on paper. Second, they're tangible. You can't print farmland. You can't create rental properties out of thin air. Supply is constrained while demand for food and shelter never goes away. Allocate 10 to 15% to real assets. For most people, that means real estate investment trusts that own income-producing properties. How do you invest in real assets without buying the farm? Start with farmland REITs. Ticker symbol LAND is Gladstone Land Corporation. They own farms across the U.S. and lease them to farmers. Current dividend yield around 3%. Ticker symbol FPI is Farmland Partners. Similar model. For residential real estate, consider Realty Income, ticker symbol O. They own over 11,000 properties and pay monthly dividends. They've increased dividends for 29 consecutive years. For diversified real estate exposure, buy Vanguard Real Estate ETF, ticker symbol VNQ. It holds hundreds of REITs across residential, commercial, industrial, and healthcare properties. If you have significant capital and expertise, direct ownership of rental properties or farmland is even better. But most people don't have the capital or time. REITs give you exposure without operational headaches. So those are the four assets that preserve wealth during debt cycle crises. 10 to 15% physical gold and silver, 30 to 35% businesses with pricing power, 20 to 25% short-term treasuries and cash, 10 to 15% productive real assets. That's 70 to 90% of your portfolio in these four categories. The remaining 10 to 30% is where you can take intelligent risks based on your age and expertise. Maybe emerging markets, maybe commodities, maybe technologies you understand deeply. But the core 70 to 90% is defensive. It's designed to survive what's coming. Now, here's where most people screw up. They understand the problem. They agree with the analysis. But that asset and then rises stocks in a band, sell everything, buy gold, and sit in cash waiting for the apocalypse. Then markets go up for another year. They miss the gains. Their gold goes nowhere. And they feel like idiots. That's not how you do this. Here's the systematic approach. Step 1. Calculate your timeline. How many years until you need this money? If you're 35 and planning to retire at 60, you have 25 years. You can reposition gradually over 12 months. If you're 58 and planning to retire at 65, you have 7 years. You need to move faster. Reposition over 3 to 6 months. The closer you are to needing the money, the more urgent the repositioning. Step 2. Sell the garbage first. Start with purely speculative positions, meme stocks, cryptocurrencies you bought because they were trending, growth stocks trading at 100 times earnings with no profits. Sell that first. This week, then trim your overweight positions. If you're 80% in index funds, start bringing that down over the next 3 to 6 months. Don't try to time the perfect exit. You won't. Nobody can. Just systematically reduce exposure to vulnerable assets. Step 3, build the 4 buckets gradually. Month 1, buy your first position in physical gold. Start with 5% of your portfolio, 1 or 2 gold coins from AppMax. Open a Treasury Direct account. Month 2, research dividend aristocrats. Buy your first 2 positions in businesses with pricing power. Maybe Procter & Gamble and Johnson & Johnson. Move 10% of cash to Treasury bills. Month 3, buy 2 more pricing power businesses. Maybe a utility like NextEra Energy and a healthcare company. Add more to short-term treasuries. Month 4. Add more physical silver. Increase your gold and silver allocation to 10% total. Month 5. Add real asset exposure. Buy Realty Income or Vanguard Real Estate ETF. Add one more pricing power business. Month 6. Review your allocation. You should now be at 70 to 80% in the 4 safe assets, the rest in intelligent risks or additional cash. This gradual approach has 3 advantages. 1, you average your entry points. You're not trying to catch the perfect bottom. 2, you have time to learn and adjust. As you implement, you might discover things that don't fit your situation. 3, it's emotionally easier. Small changes over time are less stressful than one massive all-or-nothing decision. Step 4, ignore the noise. While you're repositioning, the market will probably go up. Your friends will brag about their returns. Financial media will say the bull market is back. Ignore all of it. You're not repositioning based on what's happening next month. You're repositioning based on where we are in a 75-year debt cycle. Short-term performance doesn't matter. Long-term survival does. Let me tell you what's going to happen. Most people watching this will nod along. They'll think, yeah, this makes sense, and then they'll do nothing. They'll talk themselves out of it. Maybe this is too pessimistic. Maybe I should wait and see. Maybe I should ask my advisor first. And their advisor will tell them to stay the course, because advisors make money when you're invested in their funds. They make nothing when you buy physical gold or move to cash. So you listen to them because it's easier, because change is hard. And then in 12 to 24 months, when the crisis becomes obvious to everyone, you'll remember this video and you'll think, I should have listened. But by then it's too late. You can't undo a 50% loss when you're 55 years old. The math doesn't work. Compounding doesn't have enough time. Here's what I want you to do this week. Just this week, sit down with your portfolio, actually open it, every position, every fund, every allocation. Ask yourself one question. If we're entering an inflationary debt crisis, will this position preserve my purchasing power? If the answer is no, market for sale, then make a plan. Over the next 3 to 6 months, how will you reposition into the 4 buckets? Write it down. Make it concrete. Give yourself deadlines, a system, an algorithm, something you follow regardless of what the market does, regardless of what the news says, regardless of how you feel. Because your feelings will destroy you in a crisis. Fear will make you sell at the bottom. Greed will make you buy at the top. Hope will make you hold positions that are going to zero. A system protects you from yourself. This approach has worked through every debt cycle crisis in history, 1930s, 1970s, 2008. The pattern never changes. Paper assets collapse. These 4 assets survive. The window is closing. We're in stage 7 of an 8-stage debt cycle. In 6 to 12 months, we'll be in stage 8. And by then it's too late. The people who act now will survive. The people who hesitate will become casualties. It's that simple. It's that brutal. Turn off this video. Open your portfolio. Start today. Because in 6 months, you'll either thank yourself or hate yourself. Your choice.